Welcome back. The company on our radar right now is LatentView Analytics. Now, the top line for the company looks pretty good. It's gone up by 4.7% on a quarter-on-quarter basis. Revenues have increased by 23% on a year-on-year basis, but margins for the company continue to decline. In the current quarter, margins are down to 19%, but if I compare it with about 6-8 quarters back, margins of the company used to be closer to 28 to 30%. So margins have been steadily declining for the company. In the current quarter, there is an impact of wage hikes, visa costs, plus the company has been spending on its sales and marketing to improve its go-to-market strategy, but margin decline is a bit concerning to analysts. We're now joined by Rajan, Sethuraman, the CEO of LatentView Analytics, on the show now. Rajan, morning. This is Reema here. First, if you could guide us on margins, how do you see the margin trajectory for the company from here?
Sure. Good morning, Reema. Thanks for having the show. I have mentioned on earlier interactions that we had started off on a program of investing into the front end as well as the capability development, especially in new markets such as Europe, where we are not having any significant presence. We have just not taken the foot off the pedal on those investments. And even though the last 2 quarters have been sluggish for the entire industry in terms of new demand and order closures, we believe that this is the point in time where we need to make those investments so that we are ready when the rebound happens. And that is the reason you see the margins being depressed for the last couple of quarters. One other aspect was utilization as well. I mean, we had hired quite a few people before Q4 of last year. However, the utilization has been improving now. Plus, we believe that all the investments that we needed to make on the front end and the capacity is all now under the bridge. So from here on, as the demand picks up, I'm expecting that the trajectory will be getting back to the 25% kind of a mark over the next 2-3 quarters.
You said 23% margins in the next 2 to 3 quarters? 25% in the next 2 to 3 quarters. So closer to end of FY24. But this is contingent on demand coming back. How confident are you about demand from here?
So the good news for us is that this year, as we are now wrapping up, now we have wrapped up Q1, right? We are into July. We have seen that the entire book of work that we had, that we were executing last year, all of that has been renewed. And we've also seen incremental growth with many of the existing stakeholders that we are working with in our existing accounts. And on top of that, we have almost a $50 million pipeline at this point in time. Now, there are quite a few opportunities that are $1 million plus in that pipeline. However, the sales cycle has been much longer than what we have witnessed in the past. We are expecting that some of those deals, if not all of them, will start coming through, right, as we wrap up Q2 and as we head into the second half of the year. So I would say that at this point, I'm cautiously optimistic that the second half of the year will see a stronger rebound in terms of the growth trajectory picking up.
Okay, so then what could the revenue look like in the second half of the year? I mean, this quarter itself, if you look at it on a year-over-year basis, it's around a 23% jump in the revenue. So that's looking quite positive. And you feel like there are more deals which are going to, start showing up in the second half as well. What could that mean for the revenue then?
So if things go along the lines that we are expecting, then we should be seeing overall full year growth, right, in the same range, about in the 23-25% range, if things do pan out as the way we are intending. Now, of course, as I said, we need to have at least a few of those big deals because incremental growth alone cannot create that kind of trajectory. On the incremental growth, I think we are confident. And that is what you see reflected in the first quarter. And also for the second quarter, the visibility that I have now, it kind of indicates that we will do similar or better than what you've done in Q1. H2 and much steeper trajectory will mean that some of the bigger deals also need to come in place.
Okay, a lot of these deals that you're mentioning, could you break them up and tell us what segments these are from? Because parts of your business like retail did see quite a drop this quarter as well. So could you tell us where these deals are coming from? I think retail was up 17% in Q4. Now it's come under a bit of pressure. So what's going on that front?
So retail and BFSI, I believe, will continue to remain under pressure. I'm sure that you're hearing this commentary from other IT companies as well. Where we are seeing a lot of traction is in the technology sector. We are seeing quite a bit of traction in industrial as well, especially in automotive manufacturing sectors. And we are also seeing that traction in the consumer packaged goods space. So these are the 3 sectors where we see many of the larger deals now that we're talking about.
Okay. You spoke about expanding your presence in Europe. When do you think those investments will be completed and all your efforts will fructify? Europe will actually start contributing meaningfully for you. What's the long-term plan for the European geography?
From an investment into front-end capacity and delivery capability, it's all done. Meaning that we've already factored that all in. We can up the ante more on the marketing and event spend, and we will do that as the demand scenario unfolds. The good thing is that on the back of all the investments that we have made so far, there are at least 30 plus opportunities that we have in the pipeline, which are with very interesting, high quality organizations, right, where we are having conversations. Europe in general takes much longer sales cycles since it's a very relationship driven market. In the current economic scenario, it's taking even longer. I'm expecting that over the next couple of quarters, we will start seeing the impact of all the investments that we had. In fact, in Q2 itself, we are expecting at least 2-3 new closures. We had one new logo win in Q1. I'm expecting about 2-3 happening in Q2. And then from there on, the trajectory should start picking up.
Okay, got that. Just one final question. You have around 850 crores of cash on your books. Could you tell us how you plan to deploy this? Is there anything that we should expect in the near term?
No, this is a question that I get every quarter. So the key reason for that is the inorganic opportunity pursuit, right, that we have been looking at. We have evaluated plenty of opportunities, and we have gone to the LOI stage, at least 4 of them, but they didn't pan out. Right now, as we speak, there is one other opportunity where we are about to do a letter of intent, and then there are 2 or 3 others which are at a close enough stage. I'm expecting that there will be some real closure action, right, that will happen before the end of this fiscal year for us. That's all I can share at this point in time. I think there are some interesting opportunities that are coming our way. As I mentioned earlier, we also set up a separate corporate development team. Now we have a 2-member team with background and experience in doing M&A and scouting for opportunities. So we are seeing some traction on the back of that as well, in terms of filling the funnel with high quality opportunities that we can evaluate.
Rajan, we'll leave the discussion here. Thank you very much for joining in. That's LatentView saying that if some of these mega deals close, large deals, the company could end the year with a 23 to 25% top line growth and 25% margins by Q4 of FY24, $50 million in terms of a deal pipeline. And Europe has started already bearing fruit for them. They're guiding for 2 to 3 closures in Europe, while the one eye remains firmly on potential acquisitions and opportunities. Get into